Hello, I'm Henry Becker, Director of Research with Lighthouse Wealth Management, and we put together this short video to discuss the tactical model that we use for client portfolios and how it is one more tool in helping to minimize investment risk for clients. Now, keep in mind, for the vast majority of people watching this video, the primary tool used to minimize investment risk has been diversification, where you own different asset classes like stocks and bonds and real estate that move in different directions at different times depending on macroeconomic or market conditions. Since the Federal Reserve and global central banks took hold of markets globally in the post-2008 financial crisis era, this zero interest rate or very low interest rate policy has increased correlation amongst all asset classes, meaning stocks are at all-time highs, bonds are near all-time highs, real estate, commodities, not all commodities, but many, and not all at the same time, but for the most part in the last 10 years, we've seen very high correlation, which means diversification in high correlation periods where everything's near all-time highs. Diversification doesn't add a whole lot of value. It doesn't mean it doesn't provide any, but it doesn't provide as much downside protection as one would want. Therefore, our tactical model we designed to not necessarily get you all the returns of the stock market or whatever investment we're in, but really to participate in the upside moves of the market, but also to minimize the impact of significant downside moves. And in that, there's going to be false signals where we might sell something and then it goes back up in a very short period of time, and maybe we look like dummies for selling and then it goes right back up. But there is a method to the madness, and in this next little chart, I'm going to discuss some of the points of how the tactical model works. So what we have here is a chart of the S&P 500 in the period of time leading up to the financial crisis as well as the financial crisis of '08. And what we have is the blue line is the S&P 500, the 50-day exponential moving average, going forward I'll just say EMA as an acronym, and the 200-day EMA. And what those are moving average prices. So what that means is similar to a simple average where you add up a series of numbers. In this case we'll say 50, the last 50 days pricing, divide by 50, that's your average price. Exponential just means we're putting a little more weight on the more recent prices. So for the tactical model, we look at the 50 and 200-day EMA as well as the interplay between them. So for us, a selling point is a breach of the 200-day EMA. So in this case, we see there's quite a few breaches right here in this period of time leading up to the financial crisis. These would have been periods where there were sales and then repurchases. Not a whole lot of them, but there are some sales and repurchases in here. More than likely, some of these were losing trades, small loss trades. But again, the goal of the tactical model is to protect to the downside. And if we were to look at the S&P over the last 20 years or 25 years, we would not see a lot of breaches of the 200-day. So sometimes you do get these false signals, but a lot of times when you get a lot of them in a very short period of time, oftentimes it's foretelling that something steeper is coming, steeper drop is coming. So what we have, as I said, we look at interplay. You see where the 50-day crosses under the 200-day EMA. And what this is called a death cross. And then you have the opposite over here where the 50-day goes above the 200-day. This is a gold cross. And these are strong signals, either to, in this case, a death cross to the downside, in the other case, gold cross to the upside. So we look at these as well. But if we just analyze this, we note that once the gold cross happens, even though we see the S&P come back above the 200-day, it's still under a death cross. This would have been a period where once sold right about here, meaning a breach of the 200-day, actually we'll say it's right here, there's no return back to the market. Our re-entry signal is a gold cross. And we know since 2009 the market has marched up considerably. So again, we're not trying to give you the whole dissertation on how exactly the tactical model works, but this is the basis of it. And you can see it's not perfect. There are signals that are false signals, but when it counts, both in 1987 with Black Monday. By the time the market had dropped over 20% over a few day period, the market was already under its 200 day. So a sidestep would have happened. In 2000, when the dot-com bust in 2008, you can see the market was already under its 200 day before the steep drop had already happened. So just as a diversified portfolio will have winners and losers, meaning as stocks in history, when stocks went up, bonds went down, those types of things, the tactical model will have winners and losers as well. But in this case, it typically is particular trades, winning trades, losing trades. And again, the goal is if we have 5 or 6 small losing trades, but one really big trade that minimizes a huge downdraft of 30 and 40 and 50%, those smaller quote-unquote losing trades are irrelevant in the grand scheme of what we're trying to do with tactical, which is allow investors to participate in the upside moves and minimize the significant downside moves. So I hope this video was helpful in understanding how the tactical model works and the purpose of it in a portfolio. As always, if you have any questions, issues, or concerns, feel free to reach out to me or anyone on the staff, Tom, Andy, Ed, Katie, Jonathan. Reach out to any of us and we can walk you through or give you a better understanding of the tactical model.